It seems at least like the right time to be asking that question, whether investors collectively are putting a little bit too much of their bets in terms of perceived certainty. I think I would put it that way because nothing, of course, is certain. Take a look at within the stock market here. The S&P low-volatility ETF, this is basically a subset of the S&P 500 with the stocks that have exhibited the lowest volatility. It's basically tracked the momentum S&P 500 ETF. So essentially, the slow, boring stocks are now the high momentum stocks. It's tracked very well, although more recently the low vol has pulled back a little bit. And obviously, the bond market is here. We see massive inflows into fixed income funds, out of equity funds. And whether you look between sectors or across sectors or within sectors, it shows you that the market is privileging perceived steady earnings growth, something that doesn't need the economy to do well, against cyclical. Take a look at this other chart of the Vanguard mega cap growth against the mega cap value index. This is a year-to-date chart. That's a persistent story for years right now, but it shows you that this pretty wide performance spread. That's about 11 percentage points. Obviously, high stakes when it comes to these FANG earnings and whether, in fact, they can continue to work those stocks and keep the growth stocks moving ahead. Also, I would even point out within healthcare, you're seeing only those stocks that are perceived to be secular growers working, the rest of them not. So the question now is if the Fed cuts rates, we get a little bit of a cyclical uptick in growth. Does that mean that the market is caught off sides with all this stuff? Or is the market correct in saying, hey, it's an uncertain world, growth is not that great, we have to stay with what we think is going to keep working?